So hello everyone, this is Angel Montesclaros again from Market Insights Asia Pacific. And our webinar for today is regarding the September 2022 Fed funds rate. So I will be explaining what is the impact of the Fed funds rate for this month and how can we trade it. So without further ado, let's begin. So these are the outline of the things that I'm going to be discussing today. So first, we're going to discuss what is interest rate, and then how do the interest rates affect the economy of the country? How are the interest rate determined? And what is the September 2022 Fed funds rate forecast, and how will it affect our trades? So let's start first with discussing what is interest rate. So when we say interest rates, we actually have two types. So we have the lending rate and the borrowing rate. So when we say the lending rate, this is the amount charged on top of the principal by a lender to a borrower for the use of assets. So from the word lending, when someone is lending you money or you are borrowing money, on top of the amount that you borrowed, of course, there would be a principal. The percentage of that principal times the duration of how long would you want to pay for your loan, that would be the lending rate. And then on the other hand, we have what we call the borrowing rate. This is the amount earned at the bank or credit union from a deposit account. So assuming that you have a savings account, well, most of us have it. When you put your money there, you are actually earning some kind of interest or money from putting your money in the bank. That is the borrowing rate. Now, this definition of interest rate is not what we need to know when we are trading forex. Actually, what we're interested to know is another type of interest rate, which are the origin or the foundation of the two interest rates that I discussed earlier. So the interest rates on consumer loans are typically quoted as annual percentage rate, while the annual percentage yield is the interest rate that is earned at a bank or credit union from a savings account or certificate of deposit. Now, this is the kind of interest rate that we need to know or be familiar with. This is the bank rate and the overnight rate. This is the kind of interest rate that we deal within the forex industry. So when we say bank rate or discount rate, it is the interest rate at which a nation's central bank lends money to domestic banks. If you're not familiar, the central bank is the bank of the banks. All right, so there would be times when a central bank would need to lend money to domestic banks. So the rate that is used for this kind of situation is the bank rate or the discount rate. On the other hand, we have what we call the overnight rate. This is the interest rate at which the banks charge each other when they borrow funds among themselves. So aside from borrowing money from the central bank, domestic banks can also borrow money from each other. And the interest rate that they use for this kind of transaction is what we call the overnight rate. So the banks borrow money from each other to cover deficiencies in their reserves. So every day there would be a balanced computation of how much money the banks have. And the reserve requirement would be determined by the central bank. So assuming that at the end of the day, a certain bank a certain bank does not have enough funds to cover or to meet the reserve requirement, then that bank would need to borrow money from another bank to cover that deficiency. That's why it's called overnight rate, because the balance of the banks over most of the time it changes from day to day. All right. If you have questions for whatever it is that I'm discussing now, you may leave it on the comment side over there. This would be a beginner-friendly topic, so you might find it a little bit slow for advanced and intermediate traders, but we'll be going towards that later on in the part of this webinar. Moving on. So how does the interest rate affects the economy? So there are a lot of ways that the interest rates can affect the entirety or the macroeconomics of a certain country. So these are the 5 common things that affects that the interest rate affects. All right. First is um, consumer and business spending. I will be explaining more later on. Second, we have the cost of borrowing money. Third, return of saving money or savings. Fourth, potential return of investments. And number 5, we have here economic and financial market activities. All right, so let's start first with explaining what happens if the interest rate or the lending rate goes up. All right, when the interest rate goes up, what usually happens is that it the savings interest rate and the borrowing interest rate. So we have lending and borrowing, right? The savings and the borrowing of money interest rates, they go up together. So when the borrowing of money is the interest rate is high, what usually happens is that deters us, um, businesses or consumers, individual households, to not borrow money. Why? Because we have to pay more for the interest rate, right? So it would not be wise to borrow money when the interest rate is too high. So if you don't have money that is borrowed, you only have to live within whatever is on your means or whatever you have disposable. So that could affect or that could lower down the consumer spending. That is also the same when we say and when we talk about businesses or sales, because just like households, businesses, they also take loans, they also borrow money. All right, so when the rate or when the price for the interest rate is high, if they will borrow money, they would have to move their if they are planning on expanding their businesses, their products, they would kind of hold it off for a moment because they have to think first if the profitability of the product or the project would be enough to cover the interest rate that they need to borrow. So if that is not enough, I mean the profitability or the projected profit on this on the same on the said project is not enough or the same said product, then they would put it on hold first. So third, we have here savings. As I mentioned earlier, if the lending interest rate goes up, the savings interest rate also goes up. So it's common sense that if the banks are offering us a high savings interest rate, then of course it would encourage us to save our money in the banks instead of putting it elsewhere. It's safe and you earn money. No big deal. Lastly, we have here productivity. As I this is also related to what I explained earlier. Let's assume that you need a new tractor for your business. And as of the moment, you cannot afford it with the liquidity that you have, but you really need a tractor. So one way to finance it is to take a loan from the banks. But then again, if the interest rate is too high, then you might want to put it on hold first, the buying of the tractor, and just find another way without spending too much money to find your or to fill in the productivity that you need to produce. Now, let's reverse the things, right? So, what if the lending or the interest rate is lower? Of course, consumer spending will go up. This is what we have seen during the 2008 recession, where the interest rate is too low, and then there's so many money, there's so many cheap money on the market. It boosts actually everyone's spending. It's actually not scary to borrow money if the interest rate is very low, right? Of course, if interest rates are too low and people are spending money beyond what they have, they could borrow money. Of course, sales from retail stores would go up and savings will go down because there's no it's not enough for the interest rates to cover the profitability for savings. So if you have money in the bank and you could and it's not making enough money for you, or if it's not even making money for you in certain times, even some banks, they have some countries, they have negative interest rates, right? So if it's not beneficial for you to save your money in the bank, you might want to spend it or invest it elsewhere. So that's why the savings rate goes down when the interest rate is down, and of course productivity goes up because it's easy to borrow money because the interest rate is low. All right. So let's move on to this portion. So when the interest rate is too high, it actually deters people or limits the expansion of the economy, right? It might sound like it's a bad thing to raise interest rates, but actually it's not. Because if interest rate is kept at a high level for a prolonged period of time, it can cause recession. Oh, so when recession occurs, um, it is usually defined by two consecutive quarter of a negative GDP, or when the economy contracts for two consecutive quarters. So this is now what we're seeing on the US, where we have seen 6 months already that the GDP is negative. Now, if the interest rate is too low or kept at a low level for a long period of time, there's so much money on the market. It could boost economy, but since there are so many money on the market, there's so many supply of money on the market, inflation will rise. What do we mean when we say inflation? Inflation is a rate at which prices of things that we purchase, goods that we purchase, or services that we purchase goes up, right? So inflation could be good depending on how much inflation is. So if inflation is too high like what we are experiencing today, then it's time for the central bank to do something about it because there's so many money on the market, prices are going up. It's not a good situation for the country either. So the interest rates cannot be kept too high for a prolonged period of time. It also cannot be kept too long for a prolonged period of time. So what we see always is that the central bank changes the interest rates from time to time depending on what the market needs. Again, I don't see any questions. If you have questions, please let me know. So, oh, how are interest rates determined by the central bank here? So, we have four things that could affect how the interest rates are determined. First is what we have inflation rate. As I mentioned earlier, this is the rate at which prices over the period of time increases. So if, for example, the inflation rate is 2% per year, then it means that the goods and services that we are buying or purchasing, it increases 2% year over year. All right. So inflation rate, um, this is also known as the cost of living within a country. So Next, aside from inflation rate, fiscal policy also affects the interest rate. What do we mean when we say fiscal policy? So this is the use of the government spending or tax policies to influence the economic condition in a certain country. So it's not just a central bank that dictates where the economy is going. So the government can also do something about it by means of government spending and taxation. If taxation is too high, then money that would supposedly be spent by consumers or businesses would be paid towards the government. So there would be less consumer or business spending, but government spending could be increased. That's why it's also important for fiscal policy to include government spending. Now, if the government is collecting too much money and they're not spending it, then they are sucking possibly some movement within the market. On the other hand, it could also be that the government is spending too much and they're actually incurring debt, which is if it's a manageable level, then it's okay. We also have here intermediation cost, which um, is not as important as inflation rate and fiscal policy, but there could be times when this is um, good to know. So when we say intermediation costs, financial institutions, when they offer their services to us, it costs them something. There's no such thing as free lunch. Everything has a certain amount to be paid. So when they are extending these services, they are having or they are paying for intermediation cost, right? Some of the intermediation costs are administrative costs and the cost to meet the central bank's reserve requirements. Others, there are also other factors that could affect how interest rates are determined. For example, if there would be some financial institutions that are maturing or there are risks within the market or any assets, and there would be non-performing assets. But there are two things here that you need to pay more attention to, which is inflation rate and fiscal policy. Am I going too fast? I hope I'm not. So how are interest rates actually determined? So one of the key factor for the central bank to determine where the interest rate should be, should go up, should go down, is inflation rate. Now, if you're not familiar, 2% is the base or the ideal interest rate. Around 2%, sorry, around 2%. So a little bit above 2% is okay, or a little bit below 2% is okay, as long as it is within or around 2% inflation. Now, what happens if inflation rate is far from this 2%? Then the central bank can interfere by means of changing the interest rates. So in this example, the first one, if inflation rate or the forecast is beyond the target, which means that it is above 2%, what we are experiencing now, the central bank may increase its interest rates. Again, let us go back here, right? So, so if interest rates will be going up, consumer spending will go down and savings will go up, meaning inflation will go down. All right, let's go back here. So, when central bank increases the interest rates, banks and individuals are encouraged to deposit money in the banks. The lending bank increases, of course. The central bank is the bank of the banks. So when the central bank increases their interest rates, of course, the banks usually, I said usually, it doesn't always seems to be the case. The banks or the domestic banks, they usually follow the direction from the central bank. So they would also increase their lending interest rates, and it's not wise for us to borrow money if the interest rate is too high. Less businesses and household loans. So if people are not spending, inflation will ease or inflation will go down. Hi. Is that Vishal Gupta? If you have any question, please leave it in the comment section. I will answer some of them probably during the session or later on. All right. So another way around is if the inflation rate or the forecast is below the target. So it is below 2%. This is the situation in some countries prior to 2022. For example, Japan. Inflation rate is really low there. And the Central Bank of Japan is having a hard time pulling inflation towards 2%. So, or if it's not an inflation, there is a need to increase liquidity in the financial system. Um, what the central bank does is they decreases their interest rates. They make money affordable for everyone. Hence, the banks and individuals lessen their deposits. Again, if the savings interest rate is not worth it, you would be better off spending it, enjoying your money, or investing it somewhere. You'd earn better than your savings account. Again, the bank lending rate decreases and more businesses and household borrows money. So um I if you are actually looking for a good timing to purchase a house that you would be mortgaging with the bank around the time where inflation is low is a good time to purchase your house because the market interest rate would also be below. But right now, in most countries, interest rates are too high. So, if your mortgage is actually flexible or it follows year on year what the interest rates are, then you would be paying more. I heard some people in the US are actually, if you have like a $500,000 mortgage, you are actually paying now around $1,000 more on your mortgage on a monthly basis. That's how bad inflation is if you are the borrower. And then if inflation rate is too low and the interest rates are too low, then the economic activity is stimulated because there is an overflowing supply of money in the market. So there are notes that I want you to remember. First, the central bank considers the demand and supply level for funds in the money market. So aside from inflation, they also look at the general way or the general flow of the market or their market, of course. So assuming that this is the Central Bank of the Philippines where I am from, if the government or the central bank, sorry, if the central bank thinks that the demand is too high, then they could put in more money in the circulation. If demand is so, then they could pull out money in the circulation. This enables them to keep the stability of their foreign exchange rates. Next, the central bank does not control interest rates charged by the banks, the lending investors, and the pawn shops. It would be wise for them to follow the central bank interest rate, but it is not required. Of course, there would be times when the central bank would dictate the maximum interest rates that these financial institutions can charge. Here in my country, during the first year of the pandemic, they actually forced every financial institution to have a maximum interest rate charge to their borrowers. But that is it's not always the case, and it depends if there is a need for that or none. But it's just a good to know that it's not required for financial institutions to follow the interest rates. Third, the central bank cannot set inflation rate. They are the one doing the mathematics or the computation on what is the actual inflation rate within the country that they are managing, but they cannot set it. They can just count it. They could, once they look at it and they think that it's too much or it's too low, then they would react to it. But it's not possible for them to actually set the inflation rate. So what they can do is if the inflation rate is beyond 2%, then they would try to do things that could pull it down towards the level that are good for the market, or if it's too low, then they will try to pull it up with whatever functions or means that they have. on their mandate. But it's not like, okay, the 2% is inflation right now. That's not gonna happen. Lastly, number 4, although the central bank is the one managing or setting the bank rate or the discount rate, policy rate, overnight rate, those rates, and the central bank cannot set the real interest rates. What do we mean when we say real interest rate? Is there a fake interest rate? None. But actually, when we say real interest rate, this is inflation minus the interest rates. Of course, even though the interest rates are going up, we also have to consider inflation that could also affect our value of money. Still no questions? All right. So this is the current. Now that we know what the basic informations are regarding interest rates and inflation and how are these two connected, we're now going to go to how or what is the look or outlook for the U.S. macroeconomics or U.S. macroeconomic situation. I have here screenshots of the year over year data for for the US macroeconomic situation. Oh, I forgot to put a label. Okay, I'll just try to show it to you then. Oh. All right, let's take a look at these two. I think this one could be the same. Yeah, let's not include this one. The fourth one, let's cross this out. Let's just focus on the 3 1 here. This one, this is the CPI or the Consumer Price Index. This is inflation that consumers like you and I feel. So, as you can see, inflation rate is actually continuing to go up. Anyone who remember how much the inflation rate should be? It's 2%. So, is it 2%? Sorry, is it 2% now? No, it's very far from 2%. So last year, this is for the last 12 months, right? So last year, we have seen inflation at 5.4%. This is already beyond what the central bank wants. And over the past months, it keeps on continuing, peaking at 9.1% for now. And it's still very high at 8.3%. So it's your 2 minus 8 point. This is 6.3% more than the benchmark, which is too high. Next, this is actually the producer price index or PPI. If this is the consumer inflation, this is the producer inflation. Why do we have two different kind of inflation? Consumers and businesses or producers, we buy different things. So for example, as a consumer, I buy like 4 liters of milk on a monthly or a weekly basis. But I'm not gonna be needing like a tons of glue or tons of paper from because I'm just an individual. So the prices for consumers and the prices for producers are counted separately. So this is the inflation rate again. This second picture is the inflation rate felt by producers. So this actually reflects almost the same story as the US Consumer Price Index or CPI. Starting at 4.3, slowly going up, peaking at 6.8, and then 6.3. So in comparison, the consumers are feeling more inflation than the producers. But then again, this is still beyond the 2% inflation target by the Fed. Okay. This one, on the other hand, this is the average hourly earnings. So, what do we mean when we say average hourly earnings? This is a year on year, of course. This is not the monthly. Sorry, let me just be clear. This is not the monthly change. It's the year on year change. All right. So don't be mistaken that this month we have 9.8% increase. No, this is the year on year change. So um For the average hourly earnings, this could also affect inflation. Why? Right now, the common story is that businesses are trying or finding it hard to employ people. So without employees, it's hard to run a business. So what they do is, of course, it's stupid to close your business. What you're gonna do is to find employees, but since there is a scarcity of employees on the market or the labor market is too tight, it's hard to find an employee. So to attract a new employee or a potential employee, businesses usually provides higher compensation. So if people are earning money, more money, then earnings would increase. This one is earnings. Now, how does it affect inflation? Of course, if you're making more money, you are also spending more money. This is generally true to a lot of people. I'm not saying all, but I'm saying a lot of people. Some people, if they earn more, they save more. But some people, if they earn more, they spend more. But the latter part is true to more people. So, if salary increases, we also increase our spending. And more in spending is equals to higher inflation. I have more data here. This one on the upper left corner. This is the um, non-farm payroll. So non-farm payroll is the number of jobs generated within the US with a notable exception of the farming industry and some government agencies. So if people are employed, of course, spending would increase. It's impossible for spending to increase if you don't have money to spend. You have money to spend if you have a job. So higher employment level or new job generated, more spending equals to higher inflation. So these are in 100,000. All right. So as you can see, as you can see, every month since last year, the US is generating positive job creations for most people. I mean, it goes down, yeah, but still, um, this is still positive. So how do we read this if you don't know? For example, this one, 424. So that means on the month of September last year, they have generated 424 jobs, which is high. And then the next one, October 2021, 677,000 jobs. So as long as these jobs are positive, that means they are affecting inflation to go what? Higher, right? I have read somewhere that as long as NFP does not go below 100,000 mark, that's okay. And so far we have not seen it go beyond that level. Still, if you could see 293,000 job created over here last June this year, you might think that, oh, probably US is slowing down, but actually that's not the case. As you can see, they already created so much job previously that the market is too tight. It's hard to create new jobs anymore. But it's still positive, so this is still inflation friendly. Next, this one on the upper right corner is where the unemployment rate is. Okay, what do we mean when we say unemployment rate? From the word unemployed. So these are the number of people that are not employed. It's actually hard for everyone to be employed. So I have not seen a country where unemployment rate is absolutely zero. But to keep it at the minimum level in comparison to the employment rate, that's the ideal situation. And since last year, it is continuously going down. So since more and more people are employed, they have money to spend, consumer spending is high, inflation would be higher as well. Do you have any question for me, guys? None. All right. So I have been telling you guys that inflation rate and interest rates, they go hand in hand. They go together. If the interest rate is too high, if the inflation rate is too high, they would increase what? All right, it's clear. All right. So, since they go together, how does it long or how long does it take for the economy to feel um the changes on the interest rates? Usually it takes around 12 months for our country or for everyone to feel the change in the interest rates. So, since it could take 12 months and then we are still seeing inflation go high and high and high, then it's common knowledge to think that inflation would continue for several months now, at least still 12 months. And then, even though 12 months is the general effect, or that's the start of where we could feel in the change in interest rates, there are certain assets that reacts directly once the change happen, and these two are bond rates, bond market and stock market. Of course, forex market also reacts, but outside forex market, we have the stock market and the bond market. So this is just a comparison of the 12-month CPI year on year, of course, versus the Fed funds rate. So it was very low during the pandemic, which is September 2021 until January 2022. Although inflation is going up, we could see that the Fed has not done anything yet. Um, Last year, they actually started doing something about it this year, right? So why is it capped at a low around this time? Because we're still feeling the effects of inflation, and they think that, oh, probably it's just temporary because people are going back to their workplace and businesses are opening up again. So it's just temporary that inflation will shoot. But see here, oh, around February and March, where the the Ukraine Russia war started, then it's not a temporary situation anymore. You could already think that, oh, it's not temporary. So they started to catch up with inflation. But even though they have raised interest rates already for a huge change already from here 0.25 to here, you could see inflation is still struggling, but it's still keeping its upward momentum. So here is the forecast for the Fed funds rate. So we as a trader, we could create our own forecast, of course, but it could take us years to know how to forecast interest rates because there's so many factors that we need to consider, so many type of model that we could use to forecast interest rate. But the easiest way for us is to check this forecast, which is one of the most popular, widely used, accepted forecast is coming from the CME group. This is the Fed funds rate forecast by the CME group. So this website, if you need the link, I would be sharing all of the links on the comment section probably, or I would go back later and put in all the links that you might want to check. But this website, this is online. This website, it actually tells you if there would be any changes that they're seeing on the interest rates and how much percentage they are looking and what is the number of change if there is. So for this September 2022 Fed Fund meeting, which is next week, that's why we're having this video, this webinar, they are expecting, or 82% of the analysts that they interviewed. So this is not just within them. This is a wide interview. 82% of them believes that the interest rate is gonna change to 3.25%. So in comparison, the present interest rate right now is 2.25 to 2.5%. So how much change is that? They are actually looking at around 1%, 100 basis point change. to 1.5, 1 basis point, sorry, 10, 1% change, sorry. And then 18% of them agrees that there is a change, there is an increase, because this is 3.25 to 3.5. So they are thinking that, oh, so 82% are believing this is gonna be the change. Why do I keep on going back? So 82% of the analysts believes that this would be the Fed funds rate this September, while 18% are more aggressive, thinking that it's higher and it's going to go to 3.5%. Now, aside from this one, there is also a part on the website where you could see the change. So, September from August last month here to September first week to this week, you would see that the probability for an increase to 2.75 to 3% has now gone to zero. It was believed to be 55% last month, and now nobody believes that the Fed would change the interest rate to 2.7 to 3%. So they are the interest rate will increase, but not around 2.7 to 3%. Now, right now, 82% thinks that the change would be towards 3% to 3.25%. But on the first month of, sorry, for September 12, it's 92%. So it goes up, and then a little bit lower, but it's still a very high percentage. And then there is actually an increase in the number of participants who thinks that the Fed would be more aggressive and change the interest rates to 3.25 to 3.5%. So anyone who knows what does this mean, this one? It means that more analysts or more participants on this survey agrees that the Fed would be more aggressive now in lifting the interest rate. So this is a 100% hike. Everyone agrees there would be a hike. The only issue is how much interest rate would they increase towards the current interest rate or current Fed funds rate. Now, this is not always the case. This always changes. There would be times when ease means interest rates would go down. The Fed would lower the interest rates. If the percentage here is higher, no change, meaning most participants are agreeing that there would be no change. So every meeting, it's not required for the Fed to change the interest rate. It's not required for them to raise or lower the interest rates. They could keep it as it is. It will depend on what the market needs. And the percentage here will tell us the probabilities and the probabilities for three scenarios. Ease, which is lowering interest rates, no change, and then hike, increasing the interest rates. Now, how many times do we have to, how many times does the Fed changes their interest rates? Actually, they have 8 meetings per year. So this schedule, I think, I put it here on the latter part of the presentation, but there are 8 meetings per year. It's a closed door meeting. Nobody's allowed to leak anything. And then afterwards, usually they will announce the new interest rates and monetary policy. Sometimes there would be what's that? A live interview or Q&A portion for the members of the media. That be open for members of the media. Usually the central bank leader, in this case, it's Chairman Jerome Powell, who would be answering questions from members of the media regarding the changes on the interest rates and anything related to the macroeconomic situation of the of the country. All right. Oh, so aside from CME group, we also have another one that you could use to forecast your interest rates. So since US is the largest economy of all, there's so much data or websites that we could utilize to find the accurate forecast. So this is another one, but in comparison to this one, which predicts, well, the most one, or the more, it actually provides us more information. This one is actually more on a short term forecast, and this is not reflecting the actual interest rate that they think is going to be. This is actually reflecting the median, or in the middle interest rate of where they think interest rates should be based on the forecast of what's going to happen to the economy. So based on this forecast, what can we see? Interest rates will go up all the way to 3.8%, which is a very far figure if we think, because it started from 0.25 last year. And then they're forecasting 3.8% on 2023 Q4. Now, it's not just third party, sorry, let's keep on changing. It's not just third party websites that does forecasting. Even the Fed, within the Fed, they have their own forecast, what they call the dot plot. Okay, why is it called a dot plot? Because it's composed of dots. So the dot plot is a chart that records each of the Fed's official projection for the central bank's short-term rates. So one dot here, for example, here on 2022, right? You would see dots there, right? So in general, one member of the Federal Open Market Committee, or FOMC, they would put a dot on the area where they think the median interest rates, or the average interest rate for the year, should be. So how do we analyze this? So more dot on a certain level, that means more people are agreeing that that is the median interest rates. So for 2022, the dot plot was around 3.25%, which was the forecast for this month. Now, this dot plot is not fixed within the year. They actually try to release a dot plot every quarter. So, if this changes every quarter, and what you have on the screen right now is the most recent one. So for the month of September, there would be a new dot plot together with the federal funds rate. So it's quite important. So on the right part of the screenshot, you would see here the 2022 FOMC meeting. So these are the schedules for the meetings. Those with the asterisks on the right corner, those are the dates where the summary of economic projections are released together with the monetary policy statement. So they do it 4 times a year, and then within the summary of economic projections, they project inflation, GDP, employment, unemployment rate, things like that. Within that is the dot plot. So there are so many things that you could learn within the summary. It's advanced trading if you analyze that. But if you are a short-term trader, probably it doesn't affect you as much. But if you are a medium day trader, or your trades last from several weeks to a month or two, then the projections would be very helpful for your trades if you're a swing trader, in short. All right, so on the upper part, you could actually access the statement, the monetary policy statement, the press conference summary, and the dot plot here on the upper part. But since these three are still yet to come, you cannot download anything. So if you haven't read any of this, then you could go to the official website of the Fed to check this schedule. As a trader, what you should be doing, whether you're a short-term trader, long-term swing trader, day trader, you should know these dates. This would affect the forex market for sure, 100%. There's no doubt about this. So you shouldn't just be trading and looking at the charts, looking at your MT4, MT5, whatever platform you're using. You should also be checking the news. You should also be checking the schedule of what are the things that would happen today. Don't just look at the charts, because when you look at the charts and it's moving, that means something is happening. And when it's moving already, then you're too late because you're already on the trade. Right. So now that I have explained what interest rates are, what affects interest rates, and where could we find forecast for the Fed interest rates or the Fed funds rate, let's now go and dive into let me change my screen to the MT4. Now, how do we check or how do we even apply this information to our trades? So we don't just analyze and stop at analysis. We also have to translate whatever we saw on the news, on the data, to our trades. So I would be discussing the major pairs only, those with USD, because we're talking about the Federal Reserve System here. All right. Share. Here we go. Okay. So this is the strategy that I use most of the time. It's very beginner friendly. I don't want to put so many complications on the charts, because too much analysis will paralyze you. Paralysis will cost you money. So let's keep it simple so everyone can understand. So now that we agree that Central Bank of the US or the Fed will increase the rates, the only question is how much it is. And we are seeing that on the data that we're looking, Fed is expected to be more aggressive. So there are two scenarios here. Our projection is right or we are wrong. Okay? So assuming that the projections are right, because there is 82% people agreeing that there would be a change for 75% or 75 basis point, and 18% people are agreeing it's a 10 basis point. What will happen to the US dollar? It will strengthen. So since it will strengthen, we have to find the areas or the key areas where, if you're already on a trade, you could take your profit or stop your losses, or if you haven't been on a trade yet, you're still waiting for a price to come to you, these are the areas where it's nice to go in. Let's start first with the Euro USD. So let me zoom out a bit. Since this would be my first time to do technical analysis with you guys, let me explain my strategy a little bit. I am using moving average 200. I remember I am a swing trader. My trades usually last for several weeks to a month or two, even 3 months. So I trade on a daily time frame, which is D1. Okay. These are moving average 200. My moving average are too high. I don't use low ones. I use other indicators. I have here the Ichimoku Kinko Hayo, some fractals over here, RSI over here, some stochastics here. So there are also other factors that I did not include on this chart. I put them on prior to this webinar, but since it's gonna be too cloudy, too much information on the screen, I deleted some of the lines that I usually put and instead put a confluence area. So this confluence area are support resistance areas where my multiple indicators goes. So if they are staying on the same area, that means that area is technically strong, either a strong resistance or a strong support. So for Euro USD, as we could see, it's below it's way below where it was last year. This is a very huge drop for Euro USD. Actually, I've heard some people, not my friends, because my friends are not that rich, but I've heard a lot of people are going now to Europe to shop what do we call that? Designer bags and goods, because it's too cheap there right now. Euro has taken the punch again by the US dollar. So, is it still possible for the euro to go down? On a macroeconomic level, it could still go down given that there is a strength that we see on the US dollar. So, where will it go down? You could screenshot the. Let me remove this so you could see there. It looks way nicer here. So, these are the areas where the strong support and resistances are. So we have 4 areas over here. Right now, the price is at almost parity level, 0.9997998 area. Okay, around here. So there, since the Fed funds rate would still be next week, I'm not seeing anything on the chart or on the schedule that could shift or move the price way above this level or way below this level. It should go around here, should flow here freely for several days. It will move depending on what the central bank will do. But given the situation, given the data that we have, it could go here to 0.96, almost flat area. So if you are selling, it's a good take profit area. As for a new trade, well, let me go back and insert my RSI and my stochastics. As for a new trade, my indicators are showing that it's not ideal for us to go in on a technical basis. You could still go in. Remember, our bias is still to buy US dollar, but on a technical basis, it doesn't look nice for us to enter right now. It's actually a time for take profit if you're able to ride this one. On the flip side, just in case something happened and we're all wrong, the strong resistance that I am seeing is here on the parity level, 1.0, around the parity level, slightly above parity level where our MAs are, 1.055 area here. That's Euro USD. Next, USD JPY. This is the most controversial pair for today since the Bank of Japan announced that they are, well, people are thinking that the Bank of Japan will interfere, but on historical basis, I'm so sorry, but the Bank of Japan, they're not very successful in intervening the market. So I'm not sure if it could potentially pull JPY back or not. We could see some movement today. This is because of the announcement of the BOJ, but it's not a big movement. The CPI last week was bigger than the movement today. Anyways, on a technical basis, I also do not see an opportunity for us to enter or join the USD JPY buy trade or buy position. But if we are right with the forecast, then we would be seeing 49.54 area or around 150 area. For now, that's a very strong resistance. Actually, on the fundamental side, the strong resistance for the USD JPY is 145. 0.000 or 145 level. Why? Because the BOJ announced that they would be trying to defend the area. Again, they would be trying to defend the area. Let's see if it works or not, but there is a strong, let me put a play somewhere here, 145, but let me change it to, this is not a technical support resistance. I just put whatever color. This is more on a fundamental side because the BOJ announced it that they would be defending this area. So there is a psychological resistance over there. But since USD has been on a very, very strong uptrend since last year, there is a huge, huge opportunity for a sell trade on a technical. But the fundamental isn't supporting that. But just in case, the strong support for USD would be around 1.33 first, and then 1.27 area over here. On an upside, I'm already done with the upside. So here we have 149.54 resistance and another strong resistance at 155.92. Doesn't have to be exactly there. I just do my math and that's the number it showed me, so I put it there. But it's a box over there with areas, so it could be a little bit lower or higher than, but more likely those are the plays for USD JPY. Personally speaking, I am enjoying USD JPY now for several factors, but the most or the biggest factor right now is the interest rate differential between US and Japan. Japan's second lowest interest rates for now. And USD is raising. It's about to raise again next week. So the huge differential interest rates between USD and Japan will lift USD further. And if Japan will not do anything about their interest rates, then you would be seeing 145, 146, and 155 level on this pair. Moving forward, we have here the GBP USD or the pound USD may rest. Condolence for the British royal family. May the Queen rest peacefully. Just like the USD JPY and Euro USD, it has been beaten so bad over the months. Actually, almost a year now. And this is again due to strength in USD with high inflation rate. Remember, when times are tough like this, USD is the king. So, on a technical basis, I wasn't able to remove some of the Fibonacci one. I don't like putting them there. I just like to mark it here. I don't like seeing so many lines and making my technical analysis too complicated because it's just too messy. I like clean things. All right. So right now we are on 1.155 area. And again, this is not a place to put in a new GBP USD sell trade. No. But if you're about to take your profit, you could take your profit at around 1.1252 area, or if we are right and the Fed will increase interest rates 1% or 10 basis point, then we would definitely be seeing this area over here, which is parity level for pound USD, around parity level, here. On the flip side, if miracle happens, then the strong resistance will be around 1.22, 1.27, and 1.32. I would be updating this if there would be any changes. I just put in the nearest support resistance levels. on most pairs with USD. Moving on, we have here Aussie dollar. For Aussie dollar, again, same story, just like everyone else. They have been beaten so bad. And this is one area where, oh, sorry. Again, no new trade opportunity on a technical basis. But if you are already on a trade and you want to take your profit, now is a good time since it's near the confluence over here, which is 0.668. Or if you want to wait until next week, um, a strong support would be around 6.649 or 0.65 here. I have not put any strong support over here yet because this is a psychological level 0.65 plus there is a technical basis. So many support resistances that I plotted earlier stays on this level. So it will be quite hard to beat this, not unless the Fed would increase more than 1%. Very unlikely though. Kiwi dollar, same story as everyone else. Yeah, so why the boxes are, the thickness are different because the confluence areas are different. So I just marked, so this one has a huge difference, this one has tight one. So for now, it's also near a support area, which is 0.59. Actually, this is already on a psychological level because of 0.6. If you don't know or if you're not familiar, if the decimal point is near 0 or 5, so in this case, it's 0.6 exactly, then there is a psychological support over there or resistance over there. So even though we have not been seeing technical indicators staying here, this is a psychological support or resistance. All right. Would be quite hard to beat 0.6, but if it does break, then it would continue all the way to 0.55. Again, another psychological area. USD CAD. For USD CAD, actually, this one is quite challenging because my support resistance areas are far, far away from the price. So we have support resistance here at 1.31 area, but the confluence are a little bit far, but further if it's go down. So mean if it goes down, it could go down all the way to 1.26 area, which is a big, big drop. But if it goes up, then there is a limited upside to it already because it already goes up. And unlike the Japanese yen or unlike the BOJ, Tiff Maclem is, or the Bank of Canada is actually actively updating their interest rates based on what is needed. So I don't think that it could go up further than these areas for now. For USDCHF, this one here, what should I say? You may forget or you may forget to put stop loss or take profit every once in a while, but every pair that you trade with Swiss franc, it's the first thing you should not forget. It's the first thing you should you should always have this. Thomas Jordan is not a friendly person. He intervenes. The Swiss National Bank, that's not just Thomas Jordan, but in general, the Swiss National Bank, they like to interfere a lot. So if they interfere, this will move. And if you're not prepared without TP or stop loss, I mean, you could die. So that's why I don't usually trade this pair. But actually, on a technical basis, this is a good area to buy or to enter a new trade. It is well supported by the two MAs over here. As you can see, there is a confluence support area over here. This is around 0.95. Again, another psychological level. But on the upside, it has a lot of room to go up, which is around here, 0.98, and then parity level. Right. Actually, this one is really good to trade. But don't forget to put your stop loss over here. If you want to enter, put your stop loss around not around 0.95. Gold. Lastly, this is the only commodity that I have included on this technical analysis over here. I don't like to put in oil. There's so much going on with oil right now. It doesn't just depend on the dollar alone. So let's put it on another trade. But if you're trading gold, most people would be thinking, oh, it's probably good to keep gold now because things are hard. But actually, gold does not earn interest rate. It does not. Actually, if you have gold on the bank and you put it on your safety deposit box, you are paying for the bank to keep your gold. So, does it make sense for you to keep gold when interest rates are going up? That's why it's going down. Okay? So since it's going down, it could go down. The strong support is around 1.60, 1,600 area. And there is a strong resistance around 1,813 or 1,800 area where we could see the MAs are, and I have here a confluence area. All right. Do we have any questions for you guys? Do you have any question for me? None. All right. Since there would be no questions for me as of the moment, that's okay. If you do watch this video on a later time and you just found out about me and my video and our webinar here in Market Insights Asia Pacific, then you could leave a comment on this comment section. I will try my best to answer some of them, and probably if it's too important or if it's a new it's a question with an interesting answer and an interesting question, we could actually put it into consideration for the next webinar topic. So none. All right, I have been talking for what, 60-75 minutes now. Since there are no questions on the comment section, I would be signing off. Thank you for having me. I hope you learned something about interest rate, inflation, and how it will look like on our charts. Don't forget to like and share our video here on YouTube, on Facebook. We have Facebook account, Insights Asia Pacific or APAC. We also have here YouTube, Market Insights APAC. And soon to be, we will be launching on TikTok. Although not my specialty, but you would be seeing more of me there. Thanks for having me, guys, and you guys have a good night. Bye-bye.